Welcome to This Explainer. Today, we're putting on our investigative financial analyst hats. We're going to strip away all the media hype surrounding Northern Trust's recent earnings, dive deep into their SEC filings, and rigorously stress test this company's core fundamentals. We aren't here for the flashy headlines, folks. We're here for the raw data.
But first, let's get the required housekeeping out of the way. Disclaimer: this is an educational case study and quantitative analysis for informational and entertainment purposes only. It does not constitute financial advice, investment recommendations, or an offer to buy or sell any securities. Past performance does not guarantee future results. Please consult a licensed financial advisor before making any investment decisions. All data is sourced from publicly available filings and is subject to fair use for commentary and criticism. All right, here's our agenda. We'll tackle the Q2 noise and that Visa windfall, run our cash flow and dividend models, look at multiples and assets, uncover 7 hidden red flags and 7 ignored green flags, and finally, bring in the investing masters for our final verdict. Section 1, Q2 setup and the Visa windfall. Let's just dive right into the elephant in the room.
You've probably seen the media heavily hyping up this $4.23 earnings per share figure. It paints this massive 40% EPS growth narrative. But as investigative analysts, we have to look a lot closer. To find the real truth, we absolutely must back out a $396.4 million after-tax gain from the Visa exchange offer. Once you strip away that one-time windfall, well, the actual underlying business performance becomes crystal clear and honestly far less sensational. This right here is exactly why we never ever buy a stock based solely on a headline EPS beat.
Section 2, Cash flow and dividend models. With that noise out of the way, it's time for the ultimate valuation gauntlet. Starting with Group A, our cash flow models. Assuming a standard weighted average cost of capital, our baseline DCF sits at $175. Now, if we look at unlevered free cash flow, which strips out debt to show us pure operational cash, that value climbs to $182. Factoring in total firm value gives us $180, while focusing purely on shareholder value in the FCFE model ticks it up to $185. Finally, adding the value of tax shields in our adjusted present value model lands us at $178 a share. Pivoting over to Group B, dividends and income. A standard dividend discount model is pretty conservative at $165, and assuming perpetual growth only bumps it slightly to $170. But remember, Northern Trust literally just hiked their dividend 10% to 88 cents. When we bake that into a multi-stage DDM with a high-growth terminal phase, intrinsic value jumps to 188. Meanwhile, our residual income model, which looks at book value plus excess earnings, points to $192, and economic value added rests right at 180. Section 3, Multiples and Asset Models. Let's see how the market is actually pricing these assets.
So, how are they priced relative to peers? A straightforward sector comparison puts the stock at $185. But check this out. If we look at historical acquisition premiums, that implied value actually skyrockets all the way up to $200. Looking at multiples, the trailing PE suggests a more modest valuation at $172, while an EV to EBITDA approach comes in at 184, and EV to sales sits right at 179.
Finally, let's look at the hard assets. Straight book value is $150, and a literal fire sale liquidation value drops down to $120. But their net asset value, that's market value assets minus liabilities, is a really healthy $185. And replacing this massive infrastructure today would cost around $210. Most interestingly, when we apply Black-Scholes logic to value their upcoming wealth management expansions as real options, we land at $190 per share. Section 4, the 7 hidden red flags. Time to pivot from the hard math to some serious investigative journalism. We're digging into the footnotes to uncover the deep red flags the media completely ignores. First up, price compression in liquidity products. It's happening, but it's just too granular for a catchy headline. Couple that with rising sequential funding costs dragging down the net interest margin, and you can really see some underlying margin pressure. They also booked a nearly $59 million severance charge. Wall Street loves to dismiss this as a quote-unquote one-time event, completely missing that it reveals an ongoing, highly expensive talent war. And flag 4, don't let a drop in total credit reserves fool you. Their reserves for individual, non-performing loans actually went up. Moving on, flag 5 is the macroeconomic uncertainty in commercial real estate. This is a dark cloud that just doesn't fit the sunny bull market narrative you see on TV, so it naturally gets ignored. Flag 6 involves some seriously complex derivatives accounting tied to Visa Class B swaps. Frankly, it's just too dense for a standard financial soundbite. And finally, Flag 7. That intense global talent war isn't just about severance payouts. It's actively pushing up baseline compensation costs, creating a long-term margin squeeze that a single flashy revenue beat can easily hide. Section 5. The 7 ignored green flags. On the flip side, what is the street missing that's actually positive? Let's look at the green flags hiding in plain sight. Flag 1. Over 700 basis points of operating leverage. Mainstream outlets totally ignore this because the math is considered boring. Flag 2. They also missed that wealth management assets under custody rose 13% year over year. That got completely eclipsed by the shiny Visa gain. Flag 3. Custody and fund admin fees are being driven by organic, sticky net new business, which the media tends to ignore in favor of wild market swings. And Flag 4. Massive capital safety buffers significantly exceeding minimums. But let's be honest, safety buffers are considered boring news, right up until a banking crisis actually hits. Flag 5 highlights a declining collective credit reserve in the commercial portfolio. This is a solid underlying quality improvement the media just completely missed. Flag 6 is a big one. Management quietly repurchased almost $359 million in shares at an average of $144.25. That is well below our calculated intrinsic value, but the street totally overlooked this incredibly savvy capital allocation. Finally, Flag 7, a 10% dividend hike usually just gets written off as standard practice, but that ignores the immense board confidence it signals for future cash flows. Section 6, the Masters and Final Verdict. Let's ground all this advanced math and run a reality check. How would the legendary masters of value investing view this stock today? Well, Ben Graham would likely pass. His strict Graham number formula struggles with financial sector premiums. The stock is trading well above its net current asset value, and the PE exceeds his strict limit of 15. Peter Lynch, however, he'd absolutely rate it a buy. If we calculate his specific fair value metric, equating PE to the growth rate plus dividend yield, it passes with flying colors. And Warren Buffett would also be a buy. Looking strictly at his owner's earnings formula, taking net income plus depreciation and amortization minus maintenance capex, he'd see a consistently strong return on invested capital, over 15%, protected by a highly defensible moat. Synthesizing our massive data set, the average of all 21 models yields an intrinsic value of exactly $180.19. This means the stock is currently fairly valued to slightly undervalued when we strip out that Visa gain entirely. It is trading exactly where the deep math says it should be. And this valuation is protected by a wide economic moat. Using Morningstar's 5 sources of moat, this is primarily driven by massive switching costs because institutional custody is incredibly sticky and painful to change, and efficient scale. Their $20 trillion in assets under custody creates massive operational leverage that competitors simply cannot replicate. And based on their wealth management net inflows, this moat is actively expanding over the next 3 years. So here's the crucial takeaway. The models point to a fairly valued financial fortress, guarded by an expanding moat. But those hidden price compression flags and rising talent costs we uncovered, they suggest a brewing storm on the horizon. The math says hold the line, but the footnotes whisper caution. So, which side are you on? Do your own homework. Thanks for joining me on this explainer, and keep digging into those filings.